All right. Thank you so much, Professor, for joining today. And I was really excited to do a podcast with you because I didn't attend any of your class like in the first semester and second semester, but most of my friends attended your class like APM and hedge funds. So I was like, okay, let's do this time. So yeah, can you just keep it a little towards you, the mic? Yeah. That's it. Yeah.
Well, thanks for having me, Lakshay. I'm really happy to help out and enjoy speaking with you.
Yeah, same here. And like I want to start with your introduction first. Your name is John M. Longo, and you have been a portfolio manager since like 20 years, if I'm not wrong, and you have been teaching at Rutgers for 25 years. And right now you are managing around $4.7 billion of portfolio. That's really huge because you can't see the zeros still in the value. Is there something which you want to add? Because I'm not good with introduction.
Well, it's team managed, so I guess you're referring to my position at Beacon Trust. So we have about $4.7 billion, mostly for high net worth investors, but also some institutional investors, and about 2/3 to 3/4 of the money we manage in-house. So we have a number of in-house strategies as well as fixed income. But other areas where we may not have a core competence, let's say real estate, private equity, we'll outsource that to, let's say, a BlackRock. So I'm part of a team. We have about 50 people at Beacon. I'd say about 15 people are doing the investment management, broadly speaking, and in terms of the individual strategies, maybe there's 5 or 6 of us. So yes, all in total, $4+ billion, but it's a team effort.
Okay, that's a really great thing, and because this, I really want to ask this question now. Like, what's the most amount of money you have made or return in a year?
Well, I don't know about a single year. Certainly with maybe my individual account, there have been times I've been up maybe close to 100%, including some leverage. Traditional accounts, they're probably more diversified, and let's say the S&P was up 20%. If you can add 5% on top of that, that would be good. So it really depends what you're trading. So there's a relationship between risk and return that we'll get into. I do in my personal account use options quite a bit, not much on futures, but occasionally we'll trade on margin. It's a simple answer, but we can get into some individual stocks.
Yeah, because you just said options, and I really want to expand on that, but we'll do that as we move forward. So because I want to start, because whenever we want to talk about money as such, if I ask someone like, why do you want money? And so they will answer that I want freedom.
Yes.
And people equate money as freedom.
Yeah.
And you have been in the financial industry for more than like 20-25 years. And what has been money like to you? Like, what do you think about money as a freedom?
Yeah, there's a lot of truth to that. So let me give you a famous study. There's a professor that I think we'll get into, Daniel Kahneman, a pioneer in behavioral finance. But there's another study he did with another professor at Princeton, Deaton. And they found that once you have $75,000 a year, other things above that threshold primarily determine your happiness. Now, I didn't really believe those numbers. So first of all, I adjusted for inflation. So the study happened about 15 years ago. Adjusted for inflation, that number is about 120,000. And then I made a further adjustment that what if you live in the New York metro area? And those two adjustments, the number came out to be like 180,000.
Okay.
So now if you ask yourself, if you're making $180,000 a year, can you be happy? My answer is probably yes. You can have a decent place to live, eat out once in a while, have a nice vacation. So everybody has their own number. I don't know if I want to place my specific number, but I do think that you need a certain amount of money such that you don't have to worry about paying bills day to day. And beyond that, things like friends and family and other things matter. So I would say yes, to a certain extent, money is freedom, but then there are a lot of people that are very rich that are unhappy or they don't spend their money wisely. So I say necessary but not sufficient. But I do think partially in those terms that you may have heard of this thing, Maslow's needs hierarchy, where there's a pyramid. So I think having a certain amount of money is at the base of that pyramid, but then after that, other things determine your happiness.
Yeah, but it's like mostly physiological needs on the bottom, and then
right.
the self-actualization.
That's right. Yeah, food, shelter, things, and then
And that's pretty relevant because I was reading this book from Morgan Housel, The Psychology of Money, and I also made a video on this, and he mentioned about the similar kind of point, like you should know you're enough.
That's right.
And
that's right.
That's something,
And I'm sort of close to that. I've turned down a lot of work just because I'm too busy, and I like to do things. People that I enjoy working with, and if something's too stressful, I don't enjoy it. I'm just going to say no. But I wasn't like that in my 20s. I had to maybe say yes to things I wasn't excited about. But it's we'll talk about importance of starting early, but that's an important point. So saying no, I think, is important.
Yeah, and as you said, like in the 20s, and the difference. How old are you right now, if you don't mind?
Yeah, I'm 55, so closer to retirement than starting. But no matter what, I'm going to be managing my portfolio. I enjoy following the markets.
Yeah.
But whether I'm going to, 20 years from now, managing money for other people, probably not going to be the case.
Yeah, I think 55 is good because Warren Buffett also made most of his money after 60. So
the time value of money, compound interest. We'll get into it.
Yeah. So I really want to know, like, what has changed after like 30 years, because you're talking about 20s, and how is your relationship with money changed? What was your thought process when you were like in your 20s, and what is the thought process right now? Because we see a lot of youngsters right now and they don't know anything about money.
Yeah. So there's a couple of things. So my investment philosophy has evolved over time, that there are a lot of ways to make money, and I try to consider all those ways. So as an example, if I'm looking at a value stock, I might think about how would Warren Buffett or Benjamin Graham view this. If I'm looking at a growth stock, maybe somebody like T. Rowe Price or Philip Fisher or Cathie Wood. So I didn't know about that when I was 20 years old. I didn't know about some of those investors. One good thing about being young is that if you're not starting out as wealthy, and I came from a middle-class family, it gives you an incentive to study hard and to be wealthy. So that, if you're just starting right now, it's okay. It gives you an incentive to really try hard and to try to learn from your mistakes. And as we'll discuss, starting early is really important because, number one, you'll have the time value of money working for you, kind of that snowball compound interest. But two, hopefully you'll learn from your mistakes. So among the mistakes I've made is that I had some stocks, and then once they hit my price target, I sold them. So now, even if I think a stock is overvalued, I'll probably hold on to at least half of it. And so I've owned Facebook since the IPO, now Meta, I've owned Amazon a long time, Apple a long time. And some of those positions maybe I've trimmed, but I'm going to hold on to them for the long term as long as the fundamentals are good. If the fundamentals have changed, well, that might be a reason to sell.
But like, I don't think with these big companies, there's a lot of change in the fundamentals usually.
No, the only thing that's a risk, that's not a huge risk, is kind of regulation. And then eventually kind of the law of large numbers, that if you look at Apple or Nvidia, both of which I own, those companies are $3 trillion. So, how big can they keep growing? So I would just say they'll probably grow at a slower rate. And we'll have to look at emerging regulation or competition, but I'm not going to sell those positions, at least in my personal account, as far as I can see.
So like, when did you start, did your first investment? Because I'll tell you a little bit about my story, which when I started investing. So I was in my high school and I won some money because of my singing, because I was singing at that time and won some money. I invested that money with the help of my mother's account, and there was a company called Himachal Futuristic Limited, which was a company which used to help a telecommunication company to set up towers. And there's this company called Reliance Jio in India. Okay. And it was coming up. So they started giving free internet to people, and they were coming up, they were growing. And I was like, okay, if this is coming up, the networks and everything, so I should invest in this company. So that was the basic analysis with that. And I think I grew 35% return within a year.
Well, that's a great story. So in terms of when I first started investing, the latest answer might be 16. The earliest answer might be between 5 and 10. So let me tell you the first stock that I bought. So when I was 5 or 6 or 7, like many kids, I collected baseball and football cards. Okay. It's a hobby. I was excited about it. I watched sports. And when I was 16, I was able to have my parents open up a brokerage account for me. Like during holiday gatherings, they would talk about stocks of the day like AT&T and IBM. And I was interested in it and said, well, can I open up my own brokerage account? I worked in fast food. I had a paper route, shoveled snow, like many people did things just to earn money. So where it comes into fruition is that the first stock that I bought was the company called Topps that made the baseball and football cards that I bought.
Oh.
So, maybe we'll get into talking about Peter Lynch, but his tagline is invest in what you know. And I bought Topps stock, and within a couple of years it doubled. It got taken over. I got lucky. I didn't really know anything about valuation, about PE ratios. I know they had a good product and I liked it, and they were around a long time. And but just coming full circle on it, I started collecting baseball and football cards when I was 5 or 6. When I was around 10, I started to understand it not as a hobby only, but something you could make money on. So I've sold most of my baseball cards and football cards, whatever I had, I gave to my son recently. But like the best card I had that I remember selling right around college, I had a rookie Nolan Ryan card. It was 1968. I paid $10 for it and sold it for a few $100s. And maybe today the card's a few $1,000s. I haven't looked. But I understood once I got into high school that I could maybe make some money selling these cards. You're sort of anticipating, will this young player turn out to be a superstar Hall of Fame player? That's sort of the bet you're making. And in the stock market, you're saying, will this company turn out to be the next Facebook or the next Apple? Or if they are Apple, do they have a next leg of growth? So there's a lot of parallels to it. But I got lucky that the first stock I bought eventually doubled, and that really got me into the financial markets. So
it's like
if I lost half my money, I'd probably do something different. I don't know.
Actually, this is the kind of story. And when you mentioned about your parents and coming from a middle class background, again, like I relate a lot to it, because I think that kind of money crunch makes you think about the money, and you think really fast, and you want to do like side hustle kind of thing, and this happens.
So fortunately, I was never in a position. I lived in a nice house. There was never an issue not having any food on the table, but we weren't rich. My parents mostly drive used cars. If we went out to dinner, it was kind of a big deal. So not being rich was a motivation to do well in school and try to learn, what did I need to do to be successful? And I didn't really know about Warren Buffett and things when I was in high school, but eventually I knew financial services was an area that I liked, that it could pay well. And so it was an incentive. So anyone that's just starting, it's okay. I mean, there have been many people that are much more successful than me that started from very humble means, and it was a motivator and an incentive to do well for yourself and your family.
Right. And I think this brings me to this question which I wanted to ask. And I've been talking to a lot of local Americans living out there, and most of them are living like paycheck to paycheck. And you told me about your parents. So what was your psychology when you were like a young kid? How was your parents like used to treat money as such? And how do you think it has changed right now? And I still think a lot of people are living paycheck to paycheck and not investing in stock market.
They are. So one way to think about it is that, yes, you could be living paycheck to paycheck. I mean, a lot of us, I was maybe in that position when I first started. But one thing you want to think about doing is have that mindset or mentality of a college student, that once you start making money, you don't need to spend it on extravagant things, or maybe you buy a couple of nice things for yourself. So one way to think about it is that you can try to live off your salary and bank your bonus. Or if you get a raise, you don't necessarily want to spend the entirety of your raise. So that might be one way to think about it, that it might be a struggle when you're first starting, but hopefully you're investing in yourself, either education, whether it's formal education, teaching yourself, learning skills. I'm a fan of multiple streams of income. We can talk about how I got into being a professor. It wasn't a plan when I was in my 20s. It sort of happened indirectly during the way. But as we just mentioned, that I work with an investment company. I work at Rutgers. I write some books. I'm on the board of a company. So just by doing things that you find interesting, you have multiple streams of income. And that could be something to think about if you're living paycheck to paycheck.
Yeah.
Anyone can have their own kind of internet business or side gig or Uber or whatever it is, that you're not living as much paycheck to paycheck. But, you got to start out and then just find a way, what can I do that I can actually start saving money? And then we can get into, how can you actually save? What are the vehicles?
Right.
Usually the more money you make, the more options you have. So somebody just starting, they're not going to be able to invest in venture capital or art, but they might be able to invest in the stock market or a savings account.
Right. I really like the idea of, invest in yourself thing, because a lot of youngsters are trying to think about money or think about their skills in that way, but not a lot, because people are becoming more of flashy right now. And I think in Psychology of Money, Morgan Housel did talk about like people aim to be the flashy. They see the money which Warren Buffett has, what he did, they don't see that. So
that's right. Well, I think social media exacerbates that. So when I was growing up, I guess it was in college, the internet was first starting, but there was no influencers, no TikTok or any of that. So it does place it hard. So what I would think about is that it's okay to like nice things, but you also have to find a way to live within your means. So I'll just give an example. Let's say you're a college student and you're interested in the latest pair of Nike Air Jordans. Maybe those sneakers cost $250. So okay, you can save for that $250, but that could be your big splurge, and maybe don't eat out as much with your friends, or eat a meal at home or do other things. So you want something to motivate yourself, but you clearly don't want to spend more than you make, because that's a recipe for trouble. One of the worst things you can do is run a balance on a credit card, because the average interest rate's over 20%. And Warren Buffett's making 20%, and not anymore because he's so big. So you got to look at, what am I spending versus what am I saving, and how are the two things growing?
Yeah, but I think these social media and instant gratification kind of things are keeping people away from thinking like this. I hope people start thinking in that way and stop like spending extravagantly and start investing it a bit.
You could be a smart shopper as well. Maybe there's a certain clothing item you want. You can find it online or in a thrift shop. I like to buy things on sale. There's always a sale, outlet mall. So I think being a smart shopper is a good thing, as well as there's the two sides. What am I spending versus what am I making? And I think you got to look at both. What can you do to make more money while still keeping you relatively sane and not working too much, as well as what do you absolutely need to spend on versus what do you want? The wants you want to kind of limit, and as I said, you want to kind of be nice to yourself and get certain things that you want, but not go overboard on that.
Right. So what do you think are the mistakes which a lot of people are doing right now? Mostly the people who come from a low income. And when I say low income, it's like people who are living paycheck to paycheck. And even if they intend to invest, they can't invest. What are the mistakes they are doing right now?
Well, number one, if you're living paycheck to paycheck, the first thing I would say is, is there anything you can do to increase your income? If the answer is no, then maybe you can do something to reduce your expenses. Now, you might not like it. Maybe you have to live with your parents. Maybe you have a bunch of roommates. There's a book I like called Set for Life. And it's about a young person that starts out, and he would bicycle to work because he didn't want to pay for a car. And then he lived in a condo apartment with a few people. So he found a way to limit his expenses, and then eventually he owned some real estate and had rental real estate. So there's got to be something you can do either to reduce your expenses or to increase your income. That gap you want to save. Now, certainly you need a certain amount of money in what's called an emergency fund, such that if you got with an unexpected bill, but you want to find a way to start investing. I think in the stock market for the long run, that the stock market kind of bang for the buck, the return you get for the effort, especially if you're investing in index funds, it's among the highest that you can get. Like, we can talk about real estate. I have some real estate investments. That requires a fair amount of legwork unless you're hiring a property manager. So, having a certain amount of cash reserve and then investing in stocks and not panicking and being shaken out, if we get into kind of behavioral finance. So sometimes people, let's say they invest in the market loses money, they panic, and then they say, I'm done with the stock market. That's not the mindset you want to have, because the stock market is what it is. It's always going to go up and down, but the trend over long periods of time is up. So that's an important thing to kind of understand. The market is what it is, and you're not going to change it. And you just have to live with the volatility and just have an emergency fund or something that can pay the day-to-day bills.
And like before, I really want to go deeper into the investment side, because you have mentioned a lot of things right now, stocks, real estate and everything. But before going that, I just want to know about this. In the last last to last class, you mentioned about Daniel Kahneman and his behavioral psychology is like, I have read about Daniel Kahneman, but not from the finance perspective, from the behavioral and evolutionary psychology perspective. But what have you learned from that guy when it comes to psychology?
So he's done a lot. So first of all, one of his famous books is Thinking Fast and Thinking Slow. That might be one to read. It's a long read. It's not a simple read, but it's meant for the lay public. So just to explain what it is, thinking fast is like your intuition, your kind of snap judgments, while thinking slow is your more analytical side. So how I might think about it is that a stock in the news like NVIDIA, that might be the thinking fast, that everyone's buying it, a lot of people got rich on it, but the thinking slow is, okay, the stock's gone up a lot, what is the outlook from here? And then eventually getting into things like valuation. Kahneman and his late colleague Tversky, both of them sadly have passed away, but Kahneman only passed away recently and Tversky passed away a couple of decades ago. They found out things like the value of gains and losses is not symmetric. So what I mean by that is the average person on the street losing $1 hurts twice as much as gaining $1 helps. So that tells me that most people need a diversified portfolio. And then how do you diversify? Well, we can look at things like correlation. So he did a lot to explain that people are not always rational, whether it's in the investment context or just any decisions that you're making. And sometimes you want to make a decision that is good enough. It might not be 100% rational, but you don't want to shoot yourself in the foot and yet have a decent chance of succeeding. So maybe you're not buying all these speculative kind of growth stocks, but maybe you're doing a mix of index funds and some of these stocks that have high growth potential. So that could be a way to balance it. But he's done a lot, and I think most investors are better for it. There's been many Nobel Prizes in behavioral finance since his work. Richard Thaler, who was one of his students, won a Nobel Prize. Robert Shiller did some work in behavioral finance. But Kahneman and Tversky are generally regarded with launching the field.
Right. I think Robert Shiller is like one of the famous professor in finance, because whenever someone wants to learn about finance, and if they go to Coursera, there's a course from Robert Shiller, Financial Markets.
He's great. And he's did a lot of work on valuation. One of his early papers was, do stocks move too much to be explained by changes in dividends? Because one way to view a stock is that it's the present value of the future cash flows, and dividends are the cash flow. So what you'll find is that dividends don't change that much, but stock prices are incredibly volatile. So the implication is that stock prices are moving because of rational, irrational things, noise, panic, both on the upside and downside. So that was an early contribution in kind of behavioral economics.
And I think that was the place where the sentiments came into existence, of how the market works based on the retail investor sentiments. Right. I really want to get into the investment part, because I think that's one of the most important and interesting part for a lot of people, because I know whoever is watching this video or whoever is listening to this podcast are mostly someone who has close to no idea about investment and finance. And I really want to dig deeper and from the basic.
Okay, let's get started at zero. That's fine.
So if someone hasn't started investing, what's the best strategy and how to think about the investing today, if they're listening to it right now?
So the way I would think about it is you want to have a safe bucket where you're going to use that to pay your expenses or maybe a down payment on a house or something, or pay your rent. And then more of a riskier bucket that you hope to build wealth over the long term. So in that safe bucket, you might have something like a savings account, a checking account. And then in the risky bucket, you can start out with stocks, but you eventually want to get a path on owning your own home as well. So maybe putting some money towards a down payment. So those are kind of the fundamentals. Cash type investments that have very low risk. That's for paying your bills, for safety, for saving for a down payment on a house, and then riskier investments. Some of your listeners out there might be entrepreneurs. That's sort of risk. You're putting a lot of your wealth, in this case your human capital, in an endeavor. But for your typical investor wanting to have a passive way of saving, the stock market on a dollar cost averaging basis is a good way to go. So dollar cost averaging is exactly what it sounds like, that most of us get paid every 2 to 4 weeks. You take a portion of your paycheck and you put it in some type of retirement vehicle, usually a IRA or 401k, which is generally buying a mutual fund. If you have no idea about investments, investing in index funds is a good thing to do. So the S&P 500, there's global index funds as well. These are good things to get started. You have to go in with your eyes wide open that this part is volatile and it's always going to be volatile. But think about everything that's happened over the past 50, 100 years. We've had world wars, we've had all these things, and yet as we speak, the market is close to an all-time high, up thousands of percent. So that's the way you got to think about it. And clearly, if you're just starting your career and you might be moving, you don't want to buy a home and just move in 2 years because you might lose money with the commission and everything. But if you feel some comfort in your career, you want to live in a certain area, New York metro area, wherever it is, you want to say, what can I do to gradually own my own home? And if somebody's married, you might have a spouse help paying the bills. But in America, there's certain tax advantages that if you buy a multifamily home, which is exactly what it sounds like, 2, 3, 4 people in a home, maybe you've seen a duplex, you only have to put down 3% on a mortgage.
Okay.
Now, if I could talk to my 20-year-old self, I might have done that. I waited till I was in my mid-20s, whatever, and then I put down 20%, which worked out fine. But if I put down 3%, I could have got it started earlier. And the downside of putting down the 3% in the multifamily home is that you're basically a landlord. You're attached to somebody in the house. Maybe they're partitioned by a wall.
What's exactly is multifamily?
Multifamily is exactly what it sounds like. But the simplest thing to envision is a duplex. A duplex is sort of envision like 2 condos that are attached to each other.
Okay.
But one person may own the 2 homes. Another could be a multifamily house where there's an upstairs unit and that person can't get into the downstairs unit. So they have their own lock and key.
Okay.
So it's what it sounds like, that multiple people are living in one kind of unit. And usually these homes are 2 to 4 families living in it. But as I said, there's a benefit in the U.S. tax code that if this is your primary residence, you only need to put 3% down. So the way to think about it is that your neighbor is paying half your mortgage.
Oh, okay.
But the way, you got to get enough to put down the 3% down payment. And you want to try to have good credit, which we can get into a little bit, in order to have the lowest possible interest rate as well. But for most other people, if you're not going to do the multifamily home, you can put down 10% on the home, and then you need what's called property mortgage insurance. There are also certain benefits if people are in certain groups, like if you're in the military, there are also some benefits. So there's a lot of ways to think about it, but part of the American dream, doesn't have to be American dream, it could be wherever you're living, is that it feels good to kind of own your own home and have a place that you're not stressed about, if I miss this rent payment, what's going to happen to me? So that's what I would do. Have a safe part of your portfolio, have a risky part. The risky part could be stocks, and then eventually having your own real estate in some capacity or another.
Okay, I really want to get into this specific. And for example, let's say we take a person who has a paycheck of, let's say, $4,000 a month, and his expenses come around $2,500 or something, and at the end he can invest $500 a month into some whatever he wants. How can he distribute that income? And let's say add one more layer to it. What if he already has a $10,000 of lump sum amount? Okay. How he can utilize both the things and come up with a good investment plan?
So in terms of buying a home, the lowest cost thing is probably an apartment than a condo. And the reason is that the property taxes are lower. If you have a lot of land and things, your property tax bill is going up, as well as if you have a large home. So I might think about, well, can I use some of that lump sum to put a down payment on an apartment or a condo? The answer is yes. Well, that sort of gets you halfway there, because the payment you'd be paying renting an apartment might be the same as the mortgage.
Oh, okay.
So let's say they're paying $1,000 a month to be in an apartment. It could be if they're if they have a down payment on the house with the $10,000 that you alluded to, they're paying $1,000 a month on their mortgage instead of paying to some landlord. Now, once they feel comfortable with their home and able to pay the bills, then they can start thinking about the stock market.
Okay.
And like I said, you can think, in your home country, or you can think globally. There's a lot of global index funds or ETFs that are very low cost. You can trade the world as a whole, or you can invest in specific countries like the UK, whatever you think or that you're comfortable with. But that's sort of what I would do. I would have what can I do such that I would own my home reasonably quickly as long as I'm going to live in that area? And what can I do to build long-term wealth? Let's just talk about some specific numbers. Inflation, which I know has been a big problem in recent years, historically it averages a little over 3%. Today as we speak, it's around 2.4, 2.5%. Going back a year and a half, it peaked at 9% in the US. So that is a problem because very few people are getting a raise 10% per year. But now that inflation hopefully is back in 2%, the stock market historically returns about 10% per year. No guarantee it's going to keep returning that, but 10% is a good number versus inflation at 3%, let's call it. So you're building wealth, the way to think about it, 7% per year. Conversely, if you're putting your money in a savings account, you're probably getting something close to 3 or 4%. So the savings account is something to pay your bills, something that where you can't afford to lose the money, but it's not a great vehicle for building wealth. You need to take on some risk, and that risk could be the financial markets. It could be angel investing once you have some more money. It could be investing in an entrepreneurial venture, side gig. There's been many people that had a regular job and then had a business on the side, and that business became their full-time business. So I would just describe it as there are multiple streams of income out there, and what are the ways that you can tap into it while remaining relatively happy and healthy and not putting a damper on your personal life.
Right. Actually, you explained it pretty well because So basically, I have read this book called Rich Dad Poor Dad, and there's an argument from these people like Robert Kiyosaki and again Morgan Housel, like what's the best thing to do, renting a house or buying a house? And there have been good debate about it, but I think the debate is very unnecessary if you don't know about the specific things about buying a house and about everything what you explained right now. And if you know about these intricacies and you can understand these things, then you can make a decision of renting it or buying it. Because the way you explained, buying makes more sense, and there are other ways when renting makes more sense. So you got to look at the calculation. There are some good tax advantages to owning a home. Interest payments on debt are tax deductible, and then your property taxes are deductible up to $10,000, which is reasonable for somebody first starting out. So I am a fan of it, but I don't go overboard on real estate because real estate generally appreciates at 3% per year. Now, granted, you're using some leverage, while stocks experience higher rates, and if you're using leverage and other things, you can potentially increase at a higher rate. So definitely, I think real estate's part of the foundation, but stocks, I think, give you great bang for the buck because they require not a lot of effort unless you're, we can get into talking about individual stocks, which may require some effort, but, an index fund doesn't require any effort. Right. So, if I ask you, one go solution for, let's say, I'm a student who's going to graduate in December and will get a job starting from January. And I have my loan to pay out and I'll be getting some salary and I'll be having some expenses. I can save, let's say, $500 as I mentioned. And right now, I don't know what is stock market. I don't know how stocks work. And I just want to get into stock market and invest some money. What would you do as that student who's starting in January?
So first of all, I would say, what is the interest on my student loan? I'm hoping it's like 5% or less. If it's low, then you can consider, as long as you can make your monthly payments on your student loan, consider investing in an S&P or a global index fund on a dollar cost averaging basis. You're basically buying a piece of the American stock market or buying the world stock market. And yes, there's a lot of turmoil in the world, but there always is. There's never a time where there's nothing to worry about. So I think dollar cost averaging, taking a little bit out of your paycheck, is usually a good plan because you're buying at the average price and not buying at the high price. So that's what I would do. In parallel, if somebody is really curious about the stock market, I would try to read some basic books on the market and maybe invest in certain things that they know.
Right.
Now, everybody knows what they like or what they know. What they may not know is how can you tell if a stock sort of is expensive or cheap? Now, that takes a little bit of effort. You can do a course on Coursera. You can read some books. But you want to look at what is the stock valued at and maybe what is the competition. Those two together, I think, get you to first base to buy an individual stock.
Right. And like, what's your suggestion for, like as we discuss about diversification of your portfolio? So, how would you suggest someone, like for example, I have $1,000 and I really want to like diversify my portfolio. We have real estate, we have crypto, we have stocks, we have ETFs, and we have a lot of things. So, derivatives, let's say for example, it's not an investment, but how do you allocate your fund in a way that you get the return from crypto at the same time as stocks and ETFs?
So, there's a term in investing, risk off and risk on. So risk off is what happens when the market's falling apart, what kind of assets tend to go up. So what tends to go up might be treasury securities, gold. I put crypto in the risk on bucket, so it's even more volatile than stocks.
Yeah.
I have a tiny amount allocated to crypto, a little bit in Bitcoin, a little bit more in Ethereum, but not a lot because most cryptos do not pay cash flow. And a good example that maybe parallels with the internet. So when I was a student at Rutgers in the 1990s, the internet was just starting to really take off. And Yahoo was the dominant search engine at the time, and then there were some other ones, Alta Vista, Excite, Ask Jeeves. But eventually Google came in mid-2000s and came to dominate, and they get 80-90% share. So the same thing with crypto. Right now, Bitcoin and some others, stablecoin, they're the dominant ones, but number one, they're not paying cash flow, and two, is there a better coin, the equivalent of Google of crypto, that comes and makes all those coins go by the wayside? So, I think crypto is pretty risky. I can see a need for it. We can get into it a little bit now or later, but I wouldn't put crypto as the core of my portfolio because it's excessively volatile and doesn't pay cash flow, doesn't pay dividends or anything like that.
No, actually, I agree with this because in crypto, it's a tech-based thing. So the scalability is sometimes not an issue because if you're coming up with a good tech, you can scale it. Because right now, if we talk about, let's say, we will keep Bitcoin aside for now. But if we talk about Ethereum has been helping a lot of other cryptocurrencies and projects to give a framework, right?
Yes.
Same time Solana came up and now it's becoming like a competition. So if someone tested Ethereum, now they have to fear of Solana. And then again, if we talk about Solana, base framework came up. So it's like whoever is coming up with a better technology, it's gonna outperform the other one. So it's like a lot of risky moves and everything. I completely agree with the point which you just said.
And there's no guarantee. I mean, there was even decades ago, there was VHS and Betamax, and supposedly Sony and Betamax had the better technology and VHS won. So you can put that in the risk on bucket with a small part of your portfolio, but I would just try to establish your foundation first. I know there is a desire to get rich quickly. It's extremely difficult. I mean, it occasionally happens. I mean, if somebody bought Bitcoin at $1,000 a coin, if somebody bought NVIDIA 10 years ago, they've gotten relatively rich in a relatively quick period of time. But there's a lot of books written. The theme is get rich slowly, that if you invest in the market and index funds and invest in yourself, over a couple of decades, that's when compound interest really kicks in, or, you're earning substantial interest on interest or income on income. And that's when you start feeling wealthier. So like in recent years, I've been investing in art and things. I don't really know much about it, but I know people that know something about it. And I wouldn't have invested in art in my 20s because I thought it would be speculative and, didn't think it was part of the foundation. So, I don't think crypto is the thing to get started on day one in your investing career. But it could be a small piece of your risk on bucket down the road.
How would you allocate like percentage wise if it comes to crypto, stocks, ETFs, index funds?
Well, a lot of it depends on your risk tolerance. So everyone has a certain risk tolerance. Some people are very adverse to losing money. For your college graduate just starting, let's say you're looking at your 401k, there's a rule of thumb that you can take 100 minus your age, and that should be the amount you have in your risky assets. Let's use some round numbers. 100 minus 20, maybe 80% should be in riskier assets. Let's say a diversified index fund of international stocks. The other 20% might be in cash or bond type security. So as you approach retirement, well, you can't afford to take a large drawdown. So there's two things, but also once you're making more money, you can maybe afford to lose money even though your age is going up. So you got to balance it with, what is my time horizon versus what is my, let's call it free cash flow. I've lived in the same house for probably 15 years. My wife and I, we bought a vacation home recently, so that's another house. But going back to the old house that I've lived in, my mortgage payment's been the same for the past 15 years. So maybe a little bit higher as property taxes have gone up. But as I've gotten a raise with salaries or other things, I was able to invest that extra money because my mortgage payment's the same. So, have a long-term plan and a short-term plan, and that's the way I would kind of think about it.
And I completely agree with this. And because this is what happened when I tell someone that you're going to earn 10% of the money out of your investment, as you said, like S&P can help you on around that kind of return. And when you do that, people don't realize the money they are going to earn on the compounding basis because the rule of 72, right?
Yes.
So can you talk a little bit about it and explain how compounding works? And if you can give an example which can make people think that how big compounding is.
Yeah, so rule of 72 is like how long does it take for your money to double? And you take that amount and you divide it by 72. So a simple average is that if I'm growing at 10% per year, it might take me 10 years to double my money. But when you consider compound interest, no, it's going to be closer to like 7 years.
Yeah.
So that's kind of what it is. And, it's sort of like a snowball. Not coincidentally, one of the biographies on Warren Buffett that he cooperated with is called the Snowball. And the essence of what he says is that the key to building wealth is to start with a snowball really early. And you can envision as you get older, the snowball is getting bigger and bigger. So that's your wealth growing over time. So it takes time for compound interest to work, but it works exponentially. And as you alluded to, that 99% of the wealth that Warren Buffett has made has been after age 50. And now he's 94, God bless him, hopefully lives to 100.
Yeah.
And it's because of that snowball effect that your income is earning income, and that's what you want to have do. So it's a little bit frustrating to start out early, and your wealth maybe isn't exploding the way you'd like, but they always say the first million is the hardest, right?
Yeah.
Because you're starting out with nothing, or 1,000, then 10,000, 100,000, million. So you want to have a long-term horizon.
Patience is the key.
Yeah, patience is the key, and not being shaken out of the market during the inevitable drawdowns is also key, because a lot of people want to sell and then they don't get back in as well. So, diversification is key.
Yeah. And so this question is like more of a personal question, which I'm facing right now, like in my life. And I think you could give me some idea about that. So I have been investing in stock market since some time, and I trust the market. I'm very patient about it. Like I invested in so in India, we don't have like a lot of ETFs. It's mostly mutual funds, which we have right now. And I have invested in a lot of funds, and like if I calculate the returns, it's almost like 15 to 20% of CAGR, which we have earned like over the time period. Okay. And that was good. And the strategy which I use is like basically like dollar cost averaging also. Like I do it like this. So whenever I see in the market the monthly charts, I do the candlestick, and I see whenever there's a red candle on the monthly charts, I put my money in.
Yeah.
So for example, I'm not putting every month. For example, every twice a month I saw a red candle and I put it. So because of this, my average cost comes really down, and that's quite gonna helping me. So the question which I have is like, there's one thing which I think about like investing in the stock market, and there's the other thing which I think is like building a business and having equity. Yeah. That's also the other way of building wealth. Like, can you share something regarding that?
So going back to your comments about investing with candlestick, there's a lot of ways to make money. What you're doing is technical analysis. Some people do it quite successfully. The other is fundamental analysis, looking at the kind of company and their business. And I tend to lean more towards the fundamental approach, but both I think make some sense. But your notion of maybe buying when things are cheaper is a good idea. One of Warren Buffett's famous quotes, when others are greedy, he's fearful. When others are fearful, he's greedy. So usually something is on sale when the market is kind of falling apart. And if you can adjust your mindset to saying, okay, things don't look so good right now, but 2 or 3 years down the road, it might bounce back. I think that kind of makes sense. A lot of the richest people out there, if you look at the Forbes or Bloomberg's billionaire list, most of them have started their own business. So I would describe it as, for somebody that wants to build massive wealth, having your own business that becomes very successful is probably the best way, but a lot of small businesses fail. So, but if you're passionate about something, you love doing something, I would probably try to stick it out. While your typical corporate America job, you're saving money in your 401k, and that puts you on a slow but steady path to being a millionaire. So it really depends. Certainly if somebody is young and they're starting out without a lot of family or other obligations, and you're passionate about something, maybe try that entrepreneurial venture. Certainly in technology, that can scale up pretty quickly. There are many, many tech stocks that are billions of dollars that have started within the past 10 years. I mean, AI is the latest example. Not that you or I are going to start OpenAI, but now the company is valued at $160 billion. So, and it wasn't around 10 years ago. So technology is very scalable because it's, by definition, it's on the internet. The marginal cost to produce it is zero.
Right, and I think I have seen a lot of SaaS companies coming up recently, and these companies are bought by bigger companies, and they are getting a lot of good buyout when they are sold. And I think that's one of the good things. If you have a better idea, you can just try it out. And I believe in starting not multiple businesses at the same time, just keeping it through. Even if you are failing at it, just keep it through. If you get a good business out of it and getting $1 million sale in a year, it will be a high value company eventually. So
like I said, there's been a lot of success stories in the software business. Other areas it takes a little bit more time to build, because let's say you have a nice restaurant concept. You start out with one restaurant, then two, then it takes a while to have a national chain like a Starbucks or McDonald's or So.
And as you have mentioned Warren Buffett a lot of times, and one of the greatest strategy which is most viral on the internet is about investing in S&P 500. And so if I ask you right now this, I have $10,000 and I want you to recommend me 4 ETFs. And what would you recommend to me right now?
Well, SPY would be a good one. Or you can look at VTI, which is a Vanguard Total Stock Market Index. The S&P 500, of course, looks at 500 names, while Vanguard Total Index looks at all the stocks trading on the exchange, roughly 5,000. You could look at an international index or ETF. Vanguard has a bunch of good ones. And then maybe if you want to try your hand at a certain industry that you think is going to grow. So there's certain AI ETFs, there's certain biotech ETFs. Maybe you want to put a small amount in something that has, higher growth potential than just the market as a whole.
Microchip is one of the good ETFs which is coming up because of NVIDIA, AMD, and SMJ.
Yeah, like I said, there are a lot of theme ETFs. So a lot of investors don't know much about individual stocks, but they like certain themes, whether it's AI, clean energy. There are a lot of ways to play it. So figure out what theme you like and dollar cost average with that in a low cost ETF.
So currently, what are you on high up on? What do you think is going to grow?
Well, right now we're approaching the election season, and I still have a lot of equities and things, but I do realize this is a higher than average risk period for the market. We're entering earnings, entering the election season, so I've been doing some covered calls on my portfolio, which, many of your readers don't know what an option is, but an option allows you, the way I think about it, you can think about it as a cushion. So let's say there's a stock and I'm writing a at the money option, which means where it is, and I can get a 20% premium on it. What happens if the market goes down 20%, I kind of lose nothing because I have that 20% cushion. If the market goes up 1, 5, 10%, I still get that 20%. If the market goes up 30, I'm capped out at 20. So that's a strategy I like in this environment where the PE of the market's around 22. We have the historical October, September volatile period, elections, earnings, the wars. But, other than that, you might say, well, when the valuations are better, maybe I'll invest a little bit more in the market, or maybe I'll try to buy some other things that I can find at a discount. There's always a bargain somewhere, and you want to have to look around, but sometimes it's not easy to execute. as I mentioned with real estate, I have some real estate investments, but I don't know that much about it. There's a person I know that's on the ground that has his own money in it, that's helping manage it. He gets a fee for that. But it's not as easy as it seems on TV, like the flipping houses and everything, because you got to find the contractors, you got to sell the house, there's property taxes. So money can be made, but you need people that know what they're doing on the ground, while your casual investor may not, it might be risky.
Flipping houses is like a great amount of footwork and takes a lot of time.
Yes. You can do it, but you need somebody that knows what they're doing, and you need good relationships with contractors.
Right.
And often you have to pay cash to get the best deals, fully cash. So, and that's a challenge for starting investors.
Right. Okay, so I want to little bit go deeper into the investing part, and because you have a book, The Art of Investing, and it talks a lot about the investors in the past. We had Warren Buffett, Peter Lynch, and everything. And I'm not going to ask you like the individual strategies. I'm going to ask you like how these people made. Became so big. Because if someone asks like how can you become rich, people will come up their own strategies, and I think like it's not about their own strategies. Whatever works best for you works best for you. So I really want to talk about these people.
Sure.
So let's say this is the first person, because we have been talking about index fund a lot. I was reading about John Bogle, and you wrote a bit about him. So who was the guy, and what was his investment strategy?
So John Bogle, it might surprise people that he didn't always, he's deceased as well, but he pioneered the index fund.
Oh, okay.
And you might say, well, what did he do before that? Well, he was actually with a company called Wellington, where he was an exec. He worked at Wellington and became an executive. He was the CEO, and then he bought a growth mutual fund that eventually blew up.
Okay.
So make a long story short, he essentially got pushed out of a company that he was working in as an active manager. And he decided to create another business, which became Vanguard, that focused on passive management. And this actually I'm a big believer that young people can do great things. So like a lot of the Nobel Prizes that we talked about were awarded to people in their 20s, if you look at the capital asset pricing model and Markowitz portfolio theory. So Bogle, when he was a student at Princeton, wrote a thesis and found that cost matters. So he didn't have the efficient market hypothesis, but he called it cost matters hypothesis, that he found that funds that had high fees generally underperformed. They didn't generate enough return to make up those fees, while funds that have low fees actually did better. So he thought about, well, what if I create an index fund and put it in a mutual fund format? There were a couple of index funds before that, but Vanguard was the first one for the retail investor. And people made fun of him at first. They called it Bogle's folly, that it didn't raise a lot of money. But over time, the performance won out because the fees are low to minimal. Vanguard has certain funds that they charge 0.03%, not 3%, not 0.3%, 0.03%. So extremely low fees. They're also tax efficient because there's very low turnover in these strategies. And they've been very successful. Buffett is a fan of individual stocks, but for his will, he made his trustee put it in index funds because his wife and kids or whoever is in his will, he doesn't want them necessarily picking stocks, and he thinks it's a great way to go. So, it's very tax efficient. You can't beat the low fees, and it's proven over time great performance. It's beaten 80% plus of active managers over most 10-year periods.
Right. And like when we talk about the concept from Benjamin Graham about the value investing, and it's like quite different because not everyone can analyze and come up with a better stock. And this was my question from you, that Warren Buffett's most of the learnings are like from Benjamin Graham, right? But like what's the main difference between these two kind of investors?
Yeah. So one of the messages I have is that for whoever's listening, your best strategy is not trying to copy Buffett or Graham or John Templeton, whoever the great investor is that you're currently admiring. Excuse me. I just taught a 3-hour class, as you know, so my voice is a little bit scratchy. So your best strategy is not copying somebody you think is great. It's basically finding kind of the combination, the Venn diagram of your specific interests, your skill set, your personality type. So let me give you an example with Benjamin Graham. Benjamin Graham was a pioneer of value investing, and how he came up with that is that he went from being rich to poor twice. His family was fairly wealthy, so when he was a young person, he lived on Fifth Avenue and had servants. Even back in 1900, that wasn't common. And his father had a business. They sold dishes, other things, and his father died when Benjamin Graham was a teenager. And then the deep recession called the Panic of 1907 happened. The business went under. His family went from being rich to poor. He was a smart guy, got a scholarship to Columbia, went to work on Wall Street, made a lot of money in the market, and then you and your listeners probably heard of the crash of 1929. Graham lost 80% of his money during that period. A lot of people lost more money because they used a lot more leverage. So he went from being rich to poor twice. And he developed, you've probably heard the expression, necessity is the mother of invention. So in his mind, he said, I went from being rich to poor twice. What kind of investment philosophy can I get such that maybe I'm not going to get super rich, but I'm not going to get poor? And so value investing tries to buy stocks that are already very cheap in price, on earnings, on cash flow, they pay dividends. One expression I like is that you can't get hurt if you fall out of the basement. Right? So there are companies out there that are trading at valuations 100, 200 times earnings. They're priced to perfection. If something goes wrong with their business model, have a competitor, those stocks can lose 50, 60, 70% overnight. Conversely, a company that's trading at 10 times earnings and is profitable, paying a dividend, they could lose money, but probably not. We have what Graham calls a margin of safety. That if you can point to evidence, historical body of evidence, you feel safer buying it. And Graham found that if you buy stuff really cheaply, often it's revalued upwards and you can have an attractive return. So Graham was never trying to hit the lights out, but was always trying to protect his downside. Like one of Buffett's humorous expressions, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So Graham's strategy worked well with smaller sums of money. He called them sometimes cigar butts. Cigar butt's not a really attractive term these days, but sometimes you'd find a cigar butt on the ground and there'd be some puffs left in it and you can get something out of it. Maybe today, like we have all these student events where somebody's presenting, sometimes there's some free food left over. That might be realistic. So Buffett was a student of Graham's at Columbia for his graduate degree, and then he worked for Graham a couple of years, but Graham eventually shut down his fund, and why he went back to Omaha. But just to answer your question, how Buffett evolved to where he was today is he found that Graham's strategy, deep value, worked pretty well when you're managing small sums of money, which is good for the starting investor. Once you're Buffett managing hundreds of billions of dollars, you're forced to buy bigger companies. So Buffett evolved to buying high quality companies he can hold for the long term. He says his favorite holding period is forever. So, Coca-Cola he's owned since the 1980s, older than some of your readers. American Express, he first bought it in the 1960s and eventually bought some later and owned it for decades. Apple is a more recent pick, but he's owned it probably close to 10 years, done well. So that's how Buffett evolved, that, I want to buy good companies that I can hold for the long term instead of these cigar butts that might be going out of business that'll get a short-term pop.
Right. And I think there was a Buffett's line, and he said he lost $10 million and someone asked him, you lost $10 million today in your portfolio. And it's that I didn't sell it. So this means that I didn't lose it yet. So this actually explains that I invest forever.
Yeah. So, I always ask myself, have the fundamentals changed? If they haven't, then you probably want to hold on to it. So one good example I use in my classes is like Apple and the smartphone. Right, the smartphone now, I think we're in version 16. So if we turn back the clock 16 years ago, the dominant phone companies of the day were Nokia and Motorola, a little bit on research and motion. We know what happened, that the smartphone was a revolution. Those companies' market share got crushed. Apple and then eventually Samsung made most of the profits. So, and that's an example where the fundamentals changed dramatically, while Buffett and Coca-Cola or American Express, the fundamentals really wouldn't have changed with those companies. Those companies are still quite strong, even though it's 20, 30 years later since he purchased them.
Right, and you were mentioning about Peter Lynch, and Peter Lynch theory is like more about buy what you know, and this strategy is more of a rational and in a practical way. Do you think that people who have no experience right now, can you explain the strategy, what he was like?
So Peter Lynch. So when I was in high school or college, I didn't know about Warren Buffett, but I knew about Peter Lynch. He was the number one mutual fund manager in the country. At one point, I think like 10% of 401k assets were in the fund he ran, Fidelity Magellan. And for those sports fans out there, he did something that was rare. That he did something that, if you're a football fan, Jim Brown or Barry Sanders or Calvin Johnson did. He sort of retired at his peak. So he beat the market like 13 years in a row, had the biggest fund out there, and he was already wealthy, and his father died at a young age. So he wrote a couple of books. One's One Up on Wall Street, and the subtitle is How to Use What You Know to Make Money in the Market. That's my favorite of his books. He wrote another one, Beating the Street, and maybe have written a third book. But the subtitle, How to Use What You Know to Make Money in the Market, makes it seem within the grasp that everyone can maybe do reasonably well in the stock market. He gives some examples that we can all relate to. He bought Dunkin' Donuts stock because he liked the coffee. Dunkin' Donuts is now national, but they started out in New England, and Fidelity is in New England, Boston. His wife liked Legs pantyhose, and then he looked at the financials. So what I would say is that Lynch made popular Invest in What You Know, but there is a sort of a subtitle. You don't want to try to overpay, so I would try to learn a little bit about accounting and basic valuation, and try to combine the two. So occasionally I'll come across a stock, let's say a biotech stock with no earnings, that I'm willing to put a small amount of my money in it, and I know it's either going to be a home run or strikeout. You don't want to put the core of your money in that. You want to put the core of your money in companies that are profitable, that are not trading at outrageous valuations, and maybe even paying a dividend. So, I would say here's my kind of risky bucket, and here's more my steady Eddie type stocks. But that's what I think Peter Lynch, besides his phenomenal performance, he made everybody think that they can do reasonably well in the stock market. Everybody knows a lot about something. It could be music, sports, fashion, gaming, and then try to see which companies are best positioned, or what Buffett calls having a moat around your business. If you have a moat around your business, it's likely to stick around.
Right. And I think in your book, you talked about almost a lot of investors, and the main, what do you think, who was one of the investor which stood out to you compared to all of them?
There's a few. So from the value investing school of thought, you got Graham and then Buffett. In the growth investing area, there was Philip Fisher and T. Rowe Price. John Templeton in international investing. And then there's all sorts of other types of investing. You mentioned technical analysis earlier. There was a guy, Jesse Livermore, that was there. So I would describe there's a lot of ways to skin the investment cat, so to speak. And as I keep coming back to, you want to find the path that is best fits with your personality and skill set. And that's probably the way that you can go. But, in terms of the stock market, you typically look at value and growth. Those are the kind of the core strategies that you see with picking individual stocks.
Because you also mentioned about Paul Tudor Jones, and I was listening to one of the podcasts from him, and he's very high on crypto right now.
Paul Tudor Jones, I'm a fan of. One comment that I mentioned is that the bigger you get, the harder it is to put up performance. In Paul Tudor Jones's early years, I think he made it more than 100% per year for 4 or 5 years in a row. That can't be because of luck. There's clearly some talent there. One thing that I like that Paul Tudor Jones says is that every day he comes in and he assumes that his investment portfolio is completely wrong, and he has to prove to himself that those holdings are still right. I think that's a nice attitude. Sometimes we get attached to a stock or stop following it. You want to make sure that the reasons that you're holding for the stock, holding this onto the stock, still make a lot of sense. Another thing that he said that resonated with me is that a trader, and I make a distinction between a long-term investor and a trader. A long-term investor is generally holding for years. A trader Generally, horizon is a year or less. And Paul Tudor Jones, what he said that stood out with me is that a trader is as willing to go long as they are short. Now, I'd be very cautious with somebody starting out going short, but maybe as you become wealthier, more sophisticated, you could do short selling as a hedge, but you don't want to wind up in a GameStop scenario where the stock explodes upward like 50-fold in 3 months. So, but that mindset I think is helpful to not getting attached to a stock too much, and proving that it still makes sense in your portfolio.
Actually, I really love the quote which you said that you have to put out a performance. It's hard to put out a performance because this is what we do in our class, right? When you give us the bull and bear case, we are coming up with the points, and when you listen to both the parties, you'll get
pretty
convinced.
good.
Yeah. So I completely get it, and I think if someone wants to check out the investing habits and whatever the previous investors have done, they can check out your book, which is called The Art of Investing.
Yeah, that one, the easiest way to get it is through Audible. I'm a fan of audiobooks, that'd be the easiest way. But there's like a written one that's a companion to it, but I'd say start out with the audiobook.
Yeah, who recorded the audio?
It's called The Great Courses, and they basically have professors from around the country, and they have them in a TV studio with some backdrop, and I enjoyed the experience.
So you recorded it?
I recorded it. I learned how to read off a teleprompter. Not that it was hard. You sort of write the script, and you can go off the script a little bit, but
how long did it take?
They did it over a course of 2 days. So the course itself is 12 hours. Actually, it spent a little bit more than 2 days, but they didn't want me to speak for like 12 hours a day because my voice would be shot. But it was a good experience. The great folks there, they have editors, they have a whole team that does graphics and everything. So I enjoyed the experience.
But you have been speaking for like 6 hours, so I would like to stop the podcast in. But thank you so much, Professor, for doing this.
My pleasure, Lakshay.
Because I think this has been one of the craziest podcasts I've ever recorded. So,
well, I hope your readers our listeners find it useful. I would just say, in closing, it's hopefully you get rich quickly, but for most of us, it's going to be a long journey. And as long as you don't give up and have the proper mindset, I think you'll be fine.
Yeah, that's perfect. Yeah. That's perfect. Thank you so much. Thank you so much for
pleasure.
coming up on the podcast.